Welcome to the deep dive. Ever feel like your S corporation tax return, Form 1120-S, is just written in some kind of secret code?
Oh, absolutely. Yeah, you're definitely not alone feeling that way.
Well, today we're going to try and, cut through that complexity.
Like a hot knife through butter, maybe.
Exactly. Our mission. Let's unpack this form, highlight the bits that really matter, and maybe most importantly for you, find those potential tax savings that often get, buried in the details.
Right. And we're not just reading the instructions here.
No.
This is about understanding the strategy, that whole flow-through nature of S-Corp, understanding how decisions the company makes actually hit your personal tax return. That's paramount.
It really is.
S-Corp have this really unique spot in the tax world, and knowing how to use that can, really help your bottom line.
Okay, so if you're ready to tackle the 2024 Form 1120- with us, figure out the important parts, and hopefully walk away feeling a bit more empowered.
And less overwhelmed.
Yeah, less overwhelmed. Let's just jump right in. All right, first things first. Let's unpack this. The most basic question is probably, do I even need to file this form? So what exactly is Form 1120-S and who really has to file it? Is it just any small business?
Yeah, that's the perfect place to start because, people see corporation and think, okay, this must be my form.
Right.
But nope, Form 1120-S is specifically the U.S. income tax return for an S corporation. And here's the absolute key. You only file this if your corporation actively elected S-Corp status.
Yeah, okay.
You had to have filed Form 2553 with the IRS, and that election needs to still be active. No 2553, no 1120-S. It's really that straightforward.
So if you didn't do that specific election, you're probably filing something else entirely, like Schedule C maybe, or a regular 1120 for a C Corp, or a 10065 for a partnership.
Yeah.
And the big deal with S-Corp, the thing everyone talks about, is this flow through, right? What does that actually mean day to day for a business owner?
It means a lot, actually. It's what really separates an S-Corp from a C-Corp, and it's a huge tax efficiency point.
Right.
With an S-Corp, most of the income, and the losses too, they aren't taxed at the company level.
Okay.
Instead, they flow through directly onto the shareholders' personal tax returns.
Yeah.
So you avoid that double taxation you hear about with C-Corp, where the company pays tax and then shareholders pay tax again on dividends.
Right, I've heard of that.
With an S-Corp, the income is generally taxed just once on your individual return. And here's a critical point, a compliance thing.
Okay.
Even if your S-Corp had zero income, zero expenses all year, if that S election is still active, you still have to file Form 1120-S.
Oh, really? Even with nothing happening?
Yep, it's mandatory. You got to file it to keep that S-Corp status going.
Huh. Good to know for those quiet years, I guess. So, okay, you've confirmed you're an S-Corp, you got to file. Now you're looking at page 1 of the form. This top part seems like just basic ID stuff, right?
It is, but getting it right is crucial.
Yeah, like the corporation's legal name, the principal office address, and you stressed this means where you actually do business, not just some registered agent's address.
Exactly, your main operational base. And they're specific about foreign addresses, too. City, province, country, postal code, no abbreviations.
Okay. Then you've got the date your S election became effective, that business activity code.
Which you need to look up in the instructions. There's a whole list.
Right. Your EIN, of course, and the date you incorporated. Seems simple, but accuracy is key, you're saying.
Precision is always key with the IRS. And pay attention to item F, total assets.
Okay. Why that one specifically?
Because that number actually determines if you need to fill out the more complex Schedule M3.
M3.
Yeah, it's a reconciliation form for S-Corp with $10 million or more in total assets. If you're under that $10 million threshold, you can usually stick with the simpler Schedule M1.
Ah, so that's a potential simplification right there for smaller businesses.
Definitely. A path to simpler compliance. Also, look at item G, the yes/no, for electing S-Corp status this year. If you check yes, you absolutely must attach Form 2553.
And if you're attaching it with the 1120-S?
That usually means it's a late election. You'll likely need to show the IRS you had reasonable cause for being late.
Gotcha. Okay, moving down a bit. Item H has these checkboxes. Final return, name change, address change, amended return, S election termination. What's the real significance here?
Well, they're your official signals to the IRS about major changes. Final return means the business is done, dissolved.
Okay.
Amended return means you're fixing a mistake on a past return. For an address change, yeah, you check the box, but the IRS really prefers you also file a separate Form 8822B.
Form 88822B. Yeah. Gets the update done faster.
Exactly. Ensures their main records are updated promptly.
Great.
Then there's item I. Enter the number of shareholders. Seems simple, right? Just count them up.
Yeah.
But it's super important for compliance because the penalties for late or wrong Schedule K-1s,
Forms that go to each shareholder.
right, those penalties are per K-1. So if you have, say, 5 shareholders and you mess up the K-1s or send them late, that penalty gets multiplied by 5.
Ouch. Okay, so that number matters for potential penalties.
It absolutely does. It keeps you accountable for informing everyone correctly.
All right, now item J. This sounds a bit more complex. Aggregated activities for Section 465 at-risk purposes and grouped activities for Section 469 passive activity purposes. Why are these even on the S-Corp return if it flows through? Don't these limits hit the shareholders individually?
That's a really, really good question. And you're right, the limitations themselves, the at-risk rules and the passive activity rules, they apply at the shareholder level.
Okay.
However, the S-Corp has the responsibility to provide all the necessary information so that each shareholder can apply those rules correctly on their own 1040.
Okay. The S-Corp gathers the data.
Precisely. Let's take at-risk first. Section 465 limits how much loss you can deduct from certain activities. Basically, you can't deduct more than you personally have at risk, meaning the amount you've invested and could actually lose.
Makes sense.
The S-Corp itself isn't subject to this limit, but it needs to tell shareholders, hey, we're involved in activities like filmmaking, farming, certain types of leasing, oil and gas exploration, things that fall under these rules. Checking the box signals that data is coming on the K-1.
Got it. And the passive activity grouping, Section 469.
Similar idea, shareholder level limit. A passive activity is usually a trade or business where the shareholder doesn't materially participate, or it's a rental activity.
Right.
The S-Corp needs to report income and loss separately for different activities. Maybe one trade or business line, a separate rental activity. Then you as the shareholder might group activities together to form an appropriate economic unit.
Like grouping two similar businesses?
Yeah. Maybe 2 coffee shops you own. You'd look at things like, are they similar? Common control, same geographic area. But the key is consistency. Once you group them, you generally have to stick with it.
And if you group them wrong,
The IRS can regroup them for you, which could, mess up your expected tax outcome. And there are rules, like you generally can't just group a rental activity with a regular trade or business unless one is kind of insignificant compared to the other, or some specific ownership tests are met.
so the S-Corp needs to report things clearly so the shareholder can make the right grouping decisions and apply the limits.
Exactly. Laying the groundwork, like you said.
Okay, that was a lot just for the top of page 1. Now let's get into the part that probably interests a lot of people, deductions. Page 1, lines 7 through 22. This is where you list your trade or business income and expenses. The instructions even have a caution. Include only trade or business income and expenses. What are the big principles here, especially if we're focused on tax efficiency, finding those savings?
That caution is super important and tells you right off the bat, not every dollar spent goes here. Things like rental activity expenses or expenses tied to portfolio income like investment interest or costs related to tax-exempt income, those don't get deducted here on page 1. They flow through separately on Schedule K.
So knowing where to put the expense is step 1.
Absolutely. Now, for tax efficiency, a huge one, especially if you make stuff or hold inventory, involves these things called the Uniform Capitalization Rules, or UNICAP, Section 263A.
UNICAP. Sounds complicated.
It can be. Basically, these rules say you can't always deduct certain costs immediately, things like direct costs, but also some indirect costs, like a portion of salaries or depreciation related to production, they have to be capitalized.
Meaning added to the cost of the inventory or asset.
Exactly. You only get the deduction when you sell the inventory or depreciate the asset over time, so it delays your deduction.
Okay, but you mentioned efficiency.
Right. Here's the big tax saver. There's a major exception for small business taxpayers.
Oh.
If your S-Corp's average annual gross receipts for the last 3 years are $30 million or less.
Okay, $30 million. That covers a lot of businesses.
It does. If you're under that threshold, you are generally exempt from UNICAP.
Which
means you can usually deduct those costs immediately instead of capitalizing them. That's a huge boost for cash flow and cuts your current taxable income. Massive benefit.
Wow. Okay, so knowing if you qualify for that small business exception is really key. Let's get into specific lines now. Lines 7 and 8, compensation of officers and salaries and wages. They're separate. Why? And what's the absolute must-know rule for S-Corp officer pay? I hear the IRS looks at this closely.
They look very closely. This is, hands down, one of the most critical tax planning spots for S-Corp owners. The rule is unavoidable. Distributions and other payments, to a corporate officer must be treated as wages to the extent the amounts are reasonable compensation for services performed.
Reasonable compensation.
Okay, what that means in practice is if you're an owner and you're working in the business as an officer, you can't just pull all the profits out as tax-free distributions.
Right.
A portion has to be paid as W-2 wages, subject to payroll taxes, Social Security, Medicare.
And if you don't, if you pay yourself too little salary,
The IRS can, and often does, reclassify those distributions you took as wages. Suddenly you owe back payroll taxes, penalties, interest. It can get very expensive.
so how do you know what's reasonable?
It's tricky, no hard number. The IRS looks at your duties, your experience, what similar jobs pay in your industry and location, the company's finances. It's a balancing act. You want to be tax efficient with distributions, but you must pay yourself a reasonable wage for the work you actually do.
Got it. Getting that balance right is crucial. Okay, line 9, repairs and maintenance. How do we know if something's a deductible repair versus something we have to capitalize and depreciate over time?
That's a constant question. The basic idea is routine maintenance that just keeps the property in good working order. Think painting, fixing a small leak, regular machine service that's usually deductible repair for line 9.
Okay, keeps it running.
Right. But if the expense results in a betterment, restores the property significantly, or adapts it to a new use, like putting on a completely new roof that extends the building's life, buying a major new piece of machinery, or a significant renovation, that generally has to be capitalized.
Added to the asset's cost and depreciated?
Exactly. You don't get the full deduction up front. Misclassifying this can really mess up your taxes.
So fixing versus significantly improving. Okay. Line 10, bad debts.
This is for business debts that became totally worthless during the year. Key point, though. If you use the cash method of accounting,
Which many small businesses do.
right, you generally can't deduct a bad debt unless you already included that amount in your income. So if a
Yeah.
client never paid you and you never recorded the income because you're cash basis, you can't then turn around and deduct it as a bad debt.
Ah, okay. Makes sense. Line 11, rents. Anything tricky here?
Mostly straightforward rent paid for business property. Just be careful about renting, say, a home from a shareholder for personal use. That gets complicated. And watch out for the inclusion amount if you lease a really expensive car, truck, or van.
An inclusion amount.
Yeah, if the vehicle's fair market value is over a certain threshold, when you start the lease, like $62,000 for leases starting in late 2023 or 2024, you have to add a small amount back into income, effectively reducing your rent deduction. It's meant to limit deductions for luxury leases.
Got it. Line 12, taxes and licenses. Pretty standard.
Yeah, things like federal import duties, excise taxes, state and local taxes directly tied to the business, like property taxes on your business building.
Okay. Now, line 13, interest. This one feels like it could have traps. What are the big limitations?
You're right to be cautious. The main hurdle is Section 163J, the business interest expense limitation. Generally, your deduction is capped. It's limited to your business interest income plus 30% of your adjusted taxable income, plus any floor plan financing interest. And critically, this limit is applied at the S corporation level.
At the shareholder level.
No, at the S corp level. Any interest expense you can't deduct gets carried forward by the corporation to future years.
But is there an out for smaller businesses?
Yes, huge relief here. Just like with UNICAP, there's a small business taxpayer exemption.
Same $30 million threshold.
Generally, yes. If your average annual gross receipts are $30 million or less and you're not a tax shelter, you're usually exempt from this 163J limitation.
So no complex calculation, no Form 8990 needed.
Typically, no. You can just deduct all your business interests. It's a major simplification and a big tax saver for many S-Corp.
That's fantastic news for a lot of listeners, I bet.
Yeah.
Okay, lines 14 through 18 seem fairly standard. Depreciation on 14, need Form 4562. Depletion on 15, but not oil and gas here. Advertising on 16, pension profit-sharing plans on 17, employee benefits on 18, all standard business costs.
Right, important deductions related to assets and employees.
Then line 19 is the energy-efficient commercial buildings deduction, needs Form 7205. And then we hit line 20, other deductions, the classic catch-all, what usually goes here, and maybe more importantly, what are the big things you absolutely should not try to deduct here?
Line 20, the everything else drawer. But yeah, you need to be careful what you put in it. Knowing the exclusions is crucial for compliance and avoiding trouble.
Okay, hit us with some key non-deductibles.
All right, big ones to watch. First, a specific one under Section 162Q. Payments for sexual harassment or sexual abuse settlements, including related attorney fees, are not deductible if they're subject to a non-disclosure agreement. That's a very clear rule now.
Okay, that's specific.
Then, expenses related to tax-exempt income. If the income isn't taxed, you generally can't deduct the costs to earn it. Those usually show up on Schedule K, but no deduction on page 1. Fines and penalties paid to a government for breaking a law are generally not deductible. There are exceptions, though. If the payment is restitution, making someone whole, or to come into compliance with the law or part of certain non-governmental orders, it might be deductible. Big difference between a penalty for violation versus a payment to fix something.
Okay, that's a tricky distinction.
Very. Then, entertainment expenses. This changed a few years back. Generally, zero deduction for entertainment. Taking clients to the game, concerts, golf not deductible as entertainment.
What about business meals?
Meals are different, we'll get to that, but pure entertainment, basically gone. There's a tiny exception if it's treated as W-2 or 1099 compensation to the recipient, but even that's limited for owners and officers.
So client entertainment is mostly out. What else?
Qualified transportation fringes, QTFs, providing employees with commuter van rides, transit passes, qualified parking. The corporation cannot deduct these costs. Club dues, memberships in business, social, recreational clubs, country clubs, golf clubs, airline lounges dues are not deductible. Lobbying expenses, costs to influence legislation or certain government officials generally not deductible. Travel for spouse dependents, generally can't deduct travel costs for someone accompanying an office employee unless they are also an employee with a real business purpose for the trip.
Okay, that covers a lot of common areas. What about those business meals?
Right, meals are still in, but usually only 50% deductible. Key conditions. The meal can't be lavish or extravagant, and an employee of the S Corp must be present. So that working lunch is often still partially deductible, but track it carefully.
So 50% for most business meals. What does go on line 20 then?
Things like business startup and organizational costs. You can elect to deduct under $5,000 of each upfront, and then you amortize the rest over 180 months. Also, certain other business expenses that just don't fit neatly into the other categories.
Okay, that's a lot to remember for line 20. Finally, line 22, ordinary business income loss. That's the bottom line from operations, right?
That's it, the net result of lines 1 through 21, and that number gets carried directly over to Schedule K, line 1, to start its journey to the shareholders.
Okay, let's shift gears to Schedule B. Title says Other Information. Seems less exciting than deductions maybe, but you're saying this is still really important.
Oh, absolutely. Don't let the name fool you. Schedule B is packed with questions that give the IRS a much broader picture of your S-Corp's structure, ownership, and certain activities. It's often where they spot flags for potential issues or areas needing a closer look.
So compliance-wise, it's critical. Let's hit some highlights. What questions should owners pay close attention to?
Definitely. Let's look at a few key ones. Question 3 asks if any shareholders are disregarded entities, trusts, estates, or nominees. If yes, you attach Schedule B1. This is about transparency. The IRS wants to know who the ultimate individual owner is receiving that K1 info.
Okay, tracing the ownership.
Question 4, A and B. These dig into ownership by the S-Corp and other entities. Does it own 20% or more or 50% or more of another corporation or partnership? If yes, you have to provide details. This flags complex structures, potential controlled groups.
Signals a bigger picture to the IRS.
Exactly. Question 6. This is about reportable transactions and Form 8918, the Material Advisor Disclosure Statement. These are transactions the IRS often views as potentially aggressive tax planning. If you were involved or required to file this form, you check yes. Failure here carries hefty penalties. Very serious compliance.
Okay, high stakes on that one.
Question 8. For former C-Corp, this asks about net unrealized built-in gain. This relates to the potential built-in gains tax if the S-Corp sells assets that appreciated back when it was a C-Corp. Helps the IRS track that potential tax liability.
Got it. Specific to former C-Corp.
Questions 9 and 10. These circle back to that Section 163J interest limitation we talked about. Did you make an election to be exempt? Do you meet the conditions that require filing Form 8990, like being over the $30 million gross receipts test and having interest expense? Ensures you handled that correctly.
Checking on the interest deduction rules.
Question 11. This one's a big compliance break for small S-Corp. It asks if total receipts and total assets were both under $250,000.
Both under $250K.
Yes, both. If you can check yes, you are generally exempt from filling out Schedule L, the balance sheet, and Schedule M1, the book-to-tax reconciliation. That saves a ton of work for smaller businesses.
Wow, okay, that's a huge simplification, worth checking eligibility there.
Absolutely. Question 12 asks about canceled or forgiven non-shareholder debt. If debt is forgiven, it often creates taxable income for the corporation, unless an exception like bankruptcy or insolvency applies. This flags potential income. Question 14A and 14B. Super common and critical. Did you make payments requiring Forms 1099, and did you file them? This covers payments to independent contractors, lawyers, etc. Failure to issue 1099s is a major penalty area. Almost every business needs to pay attention to this.
Essential compliance check there.
Question 15. About qualified opportunity funds, QOFs. If your S Corp is certifying as a QOF, you attach Form 8996 and check yes. Niche, but important if applicable.
Okay.
And question 16, the digital asset question. Did the corporation deal with digital assets like cryptocurrency, receive, sell, exchange, etc.? This is relatively new and reflects the IRS's increasing focus on tracking crypto transactions. If you're involved with digital assets, you need to answer this accurately.
Yeah, that's definitely a hot topic. So Schedule B really paints a picture for the IRS beyond just the number. Crucial compliance points all over it. Okay, now for Schedule K, you called this the heart of the S-Corp return earlier. This is where everything flows through to the shareholders, right? And where a lot of the tax havens opportunities actually show up for the individual owners.
Exactly. Schedule K is the bridge. It aggregates all the different types of income, deductions, credits, and other important items from the S-Corp's operations. Then each shareholder gets their specific slice reported on their Schedule K1. Understanding what's on Schedule K is absolutely fundamental to managing your own personal tax situation effectively.
So let's walk through the key lines. What are the big ones shareholders need to understand?
All right, let's dive in. Line 1. Ordinary business income, loss. This is the main event usually. It's the net income or loss from page 1, line 22, flows straight through, generally taxed at your ordinary income rates.
The main profit or loss number.
Right. Line 2 and 3. Net rental real estate income, loss, and other rental income expenses. These need Form 8825. Crucial point, reported separately from the main business income.
Why separate?
Because of those passive activity rules. Rental income is generally passive, and passive losses are usually limited. Reporting it separately allows you, the shareholder, to apply those limits correctly on your 1040.
Got it. Keeps passive stuff separate.
Line 4 and 5. Interest, income, and dividends. This is mostly portfolio income. Think interest, dividends, royalties, stuff not earned in the day-to-day running of the business. Reported separately because, again, different rules often apply, generally not subject to passive loss limits. And watch for qualified dividends on line 5B.
Those get lower tax rates, right?
Potentially, yes. The S-Corp checks the holding periods, passes it through, and you hopefully get the benefit of lower capital gains rates on your personal return.
Nice.
Line 11, Section 179 deduction. This is a powerhouse for tax savings. Section 179 lets you expense, meaning deduct immediately, the cost of certain new or used equipment or property instead of depreciating it slowly over years.
So a big upfront deduction.
Exactly. Greatly accelerates your tax benefit. The S-Corp calculates its limit, and your share of that deduction flows through on the K1. Very common, very valuable.
Okay, Section 179, big one. Now, line 12. Other deductions. Itemized by code. This looks like a list with codes. What's going on here?
This line is a fantastic catch-all for various deductions that pass through to the shareholder individually. The S-Corp identifies them with specific codes from the instructions.
Like what kind of deductions?
Well, charitable contributions, codes A and B for cash, non-cash. The S-Corp makes the donation, but you take the itemized deduction on your personal return, subject to your own AGI limits.
So the S-Corp doesn't deduct it, the shareholder does.
Correct. Also, investment interest expense, code C, limits your deduction for interest on investment loans. Section 59E2, expenditures, code D, allows you to elect to amortize certain costs like R&D over 10 years instead of deducting them now, which can be strategic. You'll also see things like pre-productive period expenses for farmers, code M, reforestation expenses, code O. A really interesting one for some industries is film, TV, and theatrical production costs, code X, allows expensing up to $15 million or more in some cases. Also, barrier removal cost, code Y for accessibility, and a general itemized deductions category, code Z, for things you could deduct personally if you paid them directly.
Wow, lots of specific pass-through deductions there. Now, line 13. Credits. Credits are even better than deductions, right? Dollar-for-dollar tax reduction.
Exactly. Credits are golden. They directly reduce your tax liability. The S-Corp calculates the credit amount and passes your share through on the K1 for you to claim on your 1040.
What kind of credits are we talking about?
All sorts. The low-income housing credit, codes A and B, qualified rehabilitation expenditures, code C, for fixing up old buildings. Then under other credits, code G, There's a whole alphabet soup of codes for various incentives.
Like what? Give us a few examples.
Sure, there are credits for small employer pension plan startup costs, code AE, employer-provided childcare, code AH, energy-efficient home credit, code AM, the new clean vehicle credit, code AY, credit for small employer health insurance premiums, code BA, employer credit for paid family and medical leave, code BB.
The list goes on.
So lots of potential credits tied to specific activities or investments the S-Corp makes. Definitely. It really pays to know if your S-Corp's activities qualify for any of these as they translate directly into tax savings for you.
Okay, line 16. Other tax-exempt income and non-deductible expenses. This sounds important for basis tracking.
It is, very. Non-deductible expenses, 16C. Here are things that reduce your stock basis but give you no tax deduction. Think expenses tied to tax-exempt income or those non-deductible fines and penalties we mentioned earlier.
Reduces basis, no deduction. Okay.
But crucially, tax-exempt income, 16A for interest, 16B for other, goes here too. And the big one recently under other was PPP loan forgiveness.
Ah, okay. It's not taxable income.
Correct. It's not taxable, but it increases your shareholder basis.
Why does increasing basis matter again?
Because your basis limits how much you can take out in tax-free distributions and how much loss you can deduct. So getting that tax-exempt PPP income added to your basis via line 16B is a huge benefit. It potentially allows you to take more cash out tax-free down the road.
That's a key takeaway for anyone with PPP forgiveness. Great point. Lastly, line 17, AMT and QBI items. Complex, but sounds critical, especially QBI.
Absolutely critical. The Qualified Business Income QBI deduction, Section 199, is potentially one of the biggest tax savers for owners of pass-through businesses like S-Corp.
But it's calculated on the individual return.
Yes, you calculate it on your 1040. But the S-Corp must give you all the pieces you need on the K-1 reported via line 17 codes.
What kind of pieces?
Things like your share of the qualified income or loss from each business activity, the associated W-2 wages paid by the S-Corp, and the unadjusted basis of qualified property, UBIA.
UBIA, okay.
The S-Corp also has to tell you if any of its businesses are a specified service trade or business or SSTB like doctors, lawyers, consultants, because that can limit the deduction for higher income shareholders.
So the S-Corp does the heavy lifting of gathering and reporting all the QBI components.
Precisely. They'll usually attach detailed statements. Getting this right is essential to claiming what can be a very substantial deduction, often up to 20% of your qualified business income. It's a huge tax efficiency point.
Wow. Schedule K is definitely where the action is for shareholder tax planning. Every line seems to have potential impact. Okay, we've covered income, deductions, Schedule K flow-throughs. Now, Schedule M2. Analysis of accumulated adjustments account, shareholders' undistributed taxable income, previously taxed, accumulated earnings and profits, and other adjustments account. Wow, that's a mouthful.
It is.
It looks like pure accounting stuff, maybe a bit dry. But you're saying this is vital for understanding how distributions are taxed. Why is this schedule so important for the owner?
You're hitting on something that trips up a lot of S-Corp owners. Schedule M2 is the roadmap that determines if the cash you take out of the business year distributions is taxed or not. Get this wrong, and you could face unexpected taxes. It's all about tracking different pots of money within the S-Corp.
Pots of money? Okay, explain the pots.
Let's break down the main columns or accounts. First, the Accumulated Adjustments account, AAA. This is probably the most important one for most S-Corp.
AAA.
Think of AAA as tracking the S-Corp's undistributed profits that have already been taxed to the shareholders via those Schedule K flow-throughs.
So income you've paid tax on but haven't taken out yet.
Exactly. AAA generally goes up with taxable income and down with losses, deductions, and most non-deductible expenses. And, importantly, distributions reduce AAA.
And the significance.
Huge. Distributions are generally tax-free to you, the shareholder, as long as they come from positive AAA and don't exceed your stock basis. That's the core S-Corp benefit. Pay tax once when it's earned, take it out tax-free later from AAA.
Okay, AAA is key for tax-free distributions. What's the next pot?
Shareholders' undistributed taxable income previously taxed. TTP. This is pretty rare now. It tracks undistributed income from way back before 1983.
Pre-1983. Okay, probably not relevant for most.
Probably not. But if it exists, distributions from PTEP are also generally tax-free, up to basis. There's also an election to skip PTEP if needed.
Okay. The big one people worry about is probably next. Accumulated earnings and profits, AE&P.
Right. AE&P generally only exists if the S-Corp used to be a C-Corp or acquired a C-Corp. It represents earnings that were accumulated back when it was a C Corp.
And why do we care about AE&P?
Because distributions from AE&P are taxable dividends to shareholders.
The double tax bites again.
Exactly. The income was taxed at the C Corp level, and now it's taxed again when distributed as a dividend from AE&P. You generally want to avoid distributing from AE&P if possible. Having AE&P can also trigger a special tax if the S Corp has too much passive investment income.
Okay, so AE&P means taxable distributions. Avoid if possible. Any other accounts?
Yes, the Other Adjustments Account, OAA.
OAA.
This primarily tracks tax-exempt income and related expenses, and here's where that PPP loan forgiveness shows up again. The tax-exempt income from PPP forgiveness increases the OAA, line 3, column D. The expenses paid with those forgiven funds also reduce the OAA, line 5, column D.
So it doesn't affect AAA, but it's tracked here.
Correct. It ensures that tax-exempt income properly increases your overall shareholder basis, even though it doesn't increase AAA. This tracking in OAA supports the basis increase that allows potentially larger tax-free distributions later. It correctly accounts for that PPP benefit.
Got it. So these different accounts, AAA, PTEP, AE&P, OAA, determine how distributions are taxed. Is there an order they come out in?
Yes, a very strict order, unless you make specific elections. 1, distributions first reduce AAA, tax-free, up to basis. 2, if AAA is gone, they reduce PTEP, tax-free, up to basis. 3, if PTEP is gone, then they reduce AE&P, taxable as dividends. 4, finally, if AE&P is gone, they reduce OAA, and then any other remaining basis or equity.
Wow, okay, so that order is critical. Knowing your AAA balance is key to knowing if your distributions are tax-free.
Absolutely. Managing these M2 accounts properly is fundamental S-Corp tax planning. Hashtag TAGTax6. Navigating filing requirements and avoiding penalties.
Okay, we've dissected the form, the schedules, the accounts.
Yeah.
It's a lot. But even if you fill it all out perfectly, you still have to actually file it correctly and on time, right? What are the crucial compliance nuts and bolts we need to know to avoid dropping the ball and, more importantly, avoid those nasty penalties?
You got it. This is the blocking and tackling of tax compliance. Getting these administrative pieces right saves so much hassle and potentially a lot of money.
So, first up, when to file.
Generally, the deadline is the 15th day of the third month after the S-Corp's tax year ends. For most businesses using the calendar year, that means March 15th. Since March 15th, 2025 is a Saturday.
It bumped to Monday, March 17th, 2025 for the 2024 return.
Exactly. And remember, extensions give you more time to file, but not more time to pay any tax that might be due. Payment is still generally due by the original deadline.
Okay, March 17th for calendar year filers. How about paying taxes? Can you just mail a check?
Nope, not usually for federal taxes. Corporations must use the Electronic Federal Tax Payment System, EFTPS, for all federal tax deposits, income tax, payroll tax, everything.
EFTPS. Is that hard to set up?
It's free, but you need to enroll beforehand, so don't wait until the last minute. You can also use a third-party payroll service or tax pro to make payments via EFTPS for you. There is a same-day wire option if you're really in a jam, but your bank will likely charge for that.
So plan ahead for electronic payments. Where do you actually file the return? Does it matter?
It does. The mailing address depends on where your main business is located and your total assets. That item F number again.
Different addresses based on assets and location.
Yep. For example, smaller S-Corp, under $10 assets in some East Coast states might file to Kansas City, MO. Larger S-Corp, or those in states like California or Florida, often file to Ogden, UT. Foreign filers also usually go to Ogden. You absolutely have to check the current Form 1120S instructions for the correct address for your specific situation. Sending it to the wrong place causes delays.
Double check the address in the instructions. Got it. Who has to sign the return?
It needs to be signed by a corporate officer, president, VP, treasurer, chief accounting officer, or someone else authorized. If the company's in bankruptcy, the trustee or receiver signs.
Okay, and what about that paid preparer authorization box? Should you check yes?
It can be helpful. Checking yes lets the IRS talk directly to your tax preparer about basic things like missing info, processing status, or responding to simple notices. It can speed things up without you needing to be the go-between.
Makes sense. And attaching stuff. Any rules there?
Oh, yeah. The IRS is picky. You must fill in all the required lines on the forms. Don't just write "see attached."
No, see attached.
No. If you need more space, use separate sheets, make them look like the official forms, put your company name and EIN on every single page, and attach them in the right order behind the form they support. Keep it organized. Disorganized returns invite scrutiny.
Okay, be neat, fill everything in.
Yeah.
Now the scary part, penalties to avoid. What happens if you mess up?
The penalties can be substantial, especially because S-corp penalties are often per shareholder.
Ouch. Like what?
Late filing penalty. If you file late or the return is incomplete, it's $245 per month or part of a month for up to 12 months times the number of shareholders.
$245 times shareholders per month. That adds up fast.
It really does. For a 5-shareholder S-corp, that's over $1,200 a month just for filing late. Plus, if tax is due, there's another penalty of 5% of the unpaid tax per month, up to 25%. And there's a minimum penalty if you're over 60 days late. Bottom line, file on time.
Okay, late filing expensive. What about late payment?
That's usually 0.5% of the unpaid tax per month, up to 25%. Less than late filing, but still adds up.
And what about those Schedule K-1s going to shareholders?
Big penalty risk here, too. Failure to furnish a correct K-1 to a shareholder on time is a $330 penalty per K-1.
$330 for each late or wrong K-1.
Yep. And if the IRS thinks you intentionally disregarded the rules, it jumps to $660 per K-1, or 10% of the amount that should have been reported. So getting those K-1s right and out on time is absolutely crucial. Don't underestimate this one.
Definitely not. Any other major penalties?
Penalties related to those recordable transactions we mentioned. Form 8886, Form 89888. Those are for failing to disclose potentially abusive tax shelters and can be very severe. If you're doing complex stuff, get good advice.
Sage advice. It really sounds like careful compliance and hitting deadlines is just as important financially as finding deductions. Avoid the penalties. Hashtag outro. Wow. We have covered a ton of ground today on Form 1120-S. From just figuring out if you need to file through all those deductions on page 1, the critical questions on Schedule B, the shareholder impact on Schedule K.
And Schedule M2, tracking those crucial distribution accounts.
Right. And finally, the filing requirements and those penalties you really want to avoid. It's complex, no doubt about it, but really digging into these details, especially around deductions, credits, and that flow-through feels incredibly valuable for any S-corp owner.
It really is. And hopefully this deep dive shows it's not just about ticking boxes for compliance. It's about proactively understanding the form and instructions to find and use the tax efficiency opportunities built into the code. Those small business exemptions, the choices you make about deductions, how you track AAA and OAA, these are all tools to optimize the S-corp's tax situation and ultimately your individual tax return. It's strategic.
So as you think about all this, maybe reflect on how managing your S-corp's tax life carefully, from setting reasonable officer pay to hunting down eligible credits to meticulously tracking that AAA balance, creates this unique interplay between your business structure and your personal tax strategy.
Yeah, the S-corp really is this powerful but definitely demanding entity in the business tax world.
And just consider how one seemingly small detail on that Form 1120-S, maybe an overlooked deduction or a misclassified distribution, could actually ripple through and have a pretty significant impact on your personal bottom line, your personal wealth. Understanding it really does give you more control.